Hello everyone, and welcome to the market update. Let's start with a quick snapshot of the key figures. The Nasdaq 100 ETF QQQ is trading at $648.85, while the S&P 500 ETF SPY stands at $710.14. The VIX Fear Index is at 17.48. The yield on the 10-year Treasury note has pulled back to 4.25%. The US dollar index DXY is near 98.1. In commodities, WTI crude oil is at $83.85 per barrel, and spot gold is at $4,857.60. Bitcoin is currently priced at $76,079.34. What do all these numbers tell us? They paint a clear picture of a market that's firmly in a risk-on mode. Evidence from Friday's session is compelling. The QQQ rallied 1.31%, and the SPY gained 1.21%. At the same time, the benchmark 10-year Treasury yield settled at 4.25%, stepping down from recent highs, which provides a supportive backdrop for the valuation of growth-oriented sectors like technology. Adding to this, the VIX remains subdued at 17.48, well outside panic territory. This combination signals a notable resurgence in investor appetite for risk. So, where is the money going? The flow path is quite distinct. During the Asian session, we saw a preference for growth within the Chinese A-share market, with the Chi-Next index outperforming the SSE 50 significantly. This chase for higher beta and growth carried over and intensified into the US session. On Friday, capital moved in size into tech giants like Nvidia and Tesla, and also into crypto-linked assets such as BlackRock's IBIT ETF and MicroStrategy. Even as we moved into the weekend, seeing a slight pullback in Bitcoin, down about 0.82%, this looks like a natural digestion of Friday's strong gains, more of a consolidation and recharging phase rather than a reversal of trend. Let's unpack the macro drivers behind this. On interest rates, the stability of the 10-year yield at this level is a net positive, with a high probability around 80%. The US dollar, holding relatively weak near 98.1, is also favorable, encouraging capital flows into non-US and risk assets, with a 75% probability of being a positive factor. Of course, we note that elevated oil prices, with WTI at 83.85, present a lingering inflation concern. However, the market appears temporarily desensitized to this, focusing more on the marginal improvement on the rates front. Given this setup, here's our take on key assets. For US equities, we are leaning bullish with 70% confidence. Friday's broad-based advance suggests a near-term floor is in place. As long as the 10-year yield doesn't surge back above 4.35%, the upward momentum could continue. For Chinese A-shares, we see structural opportunities, with domestically driven growth styles, exemplified by the Chi-Next board, leading the way. Bitcoin serves as a key risk sentiment barometer. Its role as a leader in this environment remains intact as long as it holds above the critical $75,000 psychological level. As for commodities like gold and oil, their elevated prices reflect a mix of inflation and hedging demand, but they face a risk of a pullback if capital rotates towards pure risk assets. In summary, we identify two dominant capital themes. First, the valuation repair for tech and growth stocks, with a 75% probability of further upside, driven directly by the retreat in bond yields. Second, the institutionalization trend in crypto, which looks bullish with an 80% probability and is seen as a medium to long-term narrative. We must, however, watch two immediate friction points. First, whether the 10-year yield can hold below the 4.3% threshold. Second, how Bitcoin tests its support around $75,000 over the weekend. Key risks that could derail this setup include any hotter-than-expected inflation data next week, which could send yields soaring, or a spike in the VIX back above 20, signaling a return of safe haven demand. Therefore, for the immediate outlook, we expect the weekend action to be predominantly consolidative, with a 50% probability, essentially building energy for potential moves early next week. Overall, the current bias leans towards risk assets, with a 40% probability assigned to further upside, 50% to sideways movement, and only a 10% chance of a downturn. Barring a macro shock, this risk-on market structure is likely to persist in the near term.